Okay, hello everybody. Hopefully everybody can hear me well enough. So
Volume is good.
volume is good, great, thank you. So we'll give folks a few more minutes to join, but while we're waiting for them, let's have an interesting little discussion. How many folks think buyers are in control when the market is rising and sellers are in control when the market is going down? Is there anybody here who believes that? Everybody must think it's a trick question. Well, when the market is going up, I will say that buyers are driving the market, but they are not controlling the market. Sellers are the ones who are controlling the market. Why is that? Well, what do buyers want to do? Buyers want to buy low and sell high, right? So if they're driving price up, they're not playing buy low and sell high anymore. They're playing buy high and try to sell higher. And that's a much less profitable game. So by driving prices up, buyers are actually hurting themselves. And as they like to say in detective shows on TV, follow the money. Who benefits when prices go up? Sellers do. In fact, if you look at other markets like real estate, they call a rising market a seller's market. And sellers are the ones who are in control. They can name their price and they can get it because you have a lack of sellers and you have buyers competing to get a seller. So while the buyers may be driving the prices up, the sellers are the ones who are in control. So that's why I prefer to use the term driving as opposed to control. So in a rising market, buyers may be driving the market, but they're not in control of it. In a falling market, sellers are the ones who are driving the market, and it's buyers who are in control. So anybody have any questions about that? Or the rationale behind that? All right. Well, let's go and get the show on the road. So welcome to the Foundry. Today we're going to be talking about the supply and demand trading methodology, and specifically about making the things you look for in that methodology objective. You've probably heard of the supply and demand trading methodology. There's a lot of places that are teaching that now. However, most of the places that are teaching that, they teach it in a very subjective fashion, where you have to train your eye to see things. And that makes it difficult to reproduce the results of the instructors. It takes a lot of time staring at charts to be able to pick out consistently the things you need to see in order to make good trades. So what we're going to be talking about here today is how we can make that process much more objective. When you have a subjective process, like for instance, one of the things we do with the supply and demand trading methodology is we pick out zones on our charts where we believe there is an imbalance between supply and demand. And when that's being done subjectively, if we go and we give the same charts to a bunch of different people, we're going to get back a bunch of different zones. When it's done objectively, then we should get back the same zones from everybody. So that's what we're going to look at trying to do here. So as we move forward through the presentation, we wake up PowerPoint here. Come on, you can do it. There we go. We're going to look at a quick overview of the supply and demand trading methodology. We're going to look at it from a 50,000-foot perspective. And then we're going to get down into the nitty-gritty. We're going to look at things like, what does a market look like? What actually is a candle? And why do we even bother to use candles? Why do we look at multiple time frames? They have what they call multiple time frame analysis. Why do we need that? We're going to look at that. And that stems directly from what candles really are. We're going to look at the relationship between the law of supply and demand and a candle, because there is a very direct relationship there, as you'll see. Then we'll get into the nitty-gritty of finding areas where supply and demand are out of balance on your charts. And then we're going to come up with a way to attempt to measure how big those imbalances are. And that's going to lead us to what patterns we're actually going to look for and how we're going to make finding of those patterns objective. Now, next week, in part 2 of this presentation, we'll actually go farther and we'll get into the intricacies of trend. And we'll look at impulse and corrective moves and the relationship between the impulse and corrective moves on one interval and the trend on a lower interval, because there is a very specific provable relationship there. And that again gets back to what candles really are, because it's derived from that. And we'll also get into curve, and we'll look at exactly what curve is. There's lots of different definitions for what curve is. Curve is one of those terms that has multiple meanings. We're going to look at it from the supply and demand perspective and how it's used in our trading. And we'll look at ways to objectively find these things. So that'll be next week's session. So let's start out now by talking about the supply and demand trading methodology. And we're going to look at this from, a high perspective here. So in the supply and demand trading methodology, what exactly are we attempting to do? Well, we're going to start out by looking at our charts and trying to find places where supply and demand is significantly out of balance. And then we're going to evaluate these places and hopefully find the ones where the imbalance is likely to stay around and is likely to affect price in the future. So when price comes back to this area, which we've identified as having this imbalance, we're expecting price behavior to change. Specifically, we're expecting price to bounce off of this area, and we're going to play the bounce. And we actually make our money off of the price movement that results in that bounce. So that is the basic idea behind this methodology. Now, there's many variations on the methodology. But all the different variations follow the same basic model. And we're going to break this model up into 4 phases. In the first phase, we're going to go out, again, looking at our charts, finding the places where supply and demand are significantly out of balance. And again, we're looking for those places where the imbalance is such that it's likely to remain there. Because there's going to be a lot of places on the chart where we can show, yeah, there was definitely an imbalance in supply and demand here. But we're not going to have anything that's going to allow us to predict that that imbalance is still there in the future when price returns to that area. So we're looking for those particular points on the chart where we can prove there was an imbalance, and that imbalance is likely to remain and affect price in the future. Now, we find these areas using something that we generically call a base isolation technique. The method we use comes from base and candle theory, but there are other methods out there that people use: order flow analysis, fair value theory. There was even one on the web called volumetric analysis. I have no idea what that is, but that's what they claimed. So there are multiple ways that people can use to try to find imbalances between supply and demand on the charts. And we're just going to lump all those together generically into what we're going to call our base isolation technique. So in generic terms, a base isolation technique then becomes a set of rules for identifying areas on the chart where supply and demand are out of balance. And you also have a set of rules that tell you how to gauge or size how big the imbalance is and whether it's likely to hang around and affect price movement in the future. And then there'll also be some rules as to how to draw your zone or your band. We'll use those two terms interchangeably here, but how to draw that on your chart. And then how, in the future, you'll use those zones or bands. But that's essentially your base isolation technique. So in phase one of the supply and demand trading methodology, we're going to be looking at the market. We're going to be finding these imbalances, and the ones that meet our criteria, we're going to turn into supplier demand bands. So at the end of phase one, we're going to have a pool of supply and demand bands that we may be able to use for trades. So that's phase one of the process. Phase two is what we call filtering. Other places have other names for this. They may call it odds enhancers or other things. But basically what we're doing here is we're taking that pool of bands that we found in phase one, these areas where we believe supply and demand are significantly out of balance, and we are using other criteria to throw away some of those zones. And ideally, the ones we're throwing away are ones that are likely to fail and not give us the kind of bounce we want that we can make money off of. So if we have a good filter, it's going to throw away bands that are not likely to give us a bounce we can make money off of. And it's going to leave us with a smaller pool of bands, which have a higher probability of giving us good bounces off of those areas that we can make money off of. So a filter is, pretty much like a water filter or an oil filter in your car. It's removing undesirable stuff from our initial pool of bands. Now, what are things that people use for filters? Well, it's very common to use trend. You could use curve. You could use momentum. For instance, you could use the RSI and have a certain preferred range of RSI values. You could use the distance to the first opposing supplier demand zone. You could use the time of day. Pretty much whatever you want, you can use as a filter. Of course, hopefully you'll choose something that actually improves your chances of success. But again, it's up to you and what you're comfortable with using. So this is phase two. Phase two, we're filtering the bands we found in phase one, hopefully getting rid of the riffraff and ending up with a smaller pool of bands that is more likely to go and give us a bounce that we can make money off of. In phase three is where we're actually going to apply a strategy. And the strategy is basically going to tell us which bands we're going to pick from the ones we have available in our filtered pool of bands. And it's going to give us an entry point, a stop point. It's going to give us an exit technique. It also is going to tell us how we're going to exploit that band. Are we going to just, buy and sell? Or are we going to try some kind of fancy options play? It's going to tell us things like, are we going to use the free trade technique? For those not familiar with that, let's say that we are going to apply the free trade technique on the SPY. The SPY is the exchange traded fund that represents the S&P 500 index. So we would have a band picked out. Let's say it's a demand band for the sake of argument. And when price comes back to that band, we're going to buy and we're going to go long. So instead of buying the normal amount, let's say 100 shares, we would go and we would buy 200 shares. And when price bounces off the zone and we have reached a point where we're up by 1-to-1 based on how much we're risking, we would sell off half of the position. And this way, if we now get stopped out on the remaining piece, the amount we lose would be equal to the amount that we just made when we sold the first piece. So after we sell the first part of our position, we are said to be in a free trade, and we can now try to see how far we can ride the second half of our position, see how far we can get. So that's why that's called the free trade method. But our strategy would tell us whether we're going to do something like that. And there's a whole range of techniques that can be employed. There's a whole range of strategies, particularly if you're involved with options. You can do things like synthetic longs, synthetic shorts. You can sell spreads. There's a whole range of things you can do there. You can combine options with the actual purchase of the underlying, in this case, the underlying shares of SPY. Lots of things you can do, but that's all in your strategy. And phase 3 is where your strategy is actually applied. And so then the final phase is phase 4, and this is execution, where we actually go and take the trade. And we're going to place our orders in accordance with our strategy. And then we're either going to get stopped out or exit with a profit, or perhaps price doesn't hit our entry point, or price may hit our entry point, but we may just not get filled. You never know. But phase 4 is the execution phase. So now let's start digging in a little deeper here. What does an actual market look like? Well, for us, our computer is essentially what the market looks like. It's our window to the market, and whatever software we're using, whether it be TradeStation, NinjaTrader, TradingView, and all the others out there that I can't remember to mention, but they're going to control what we see and how we see it and how we interface with the market. And typically, we're going to be looking at charts. But that's what we see. What does the computer actually see? Well, the computer sees an open market as a nearly continuous stream of data, particularly if it's a busy market. There's all sorts of things that can be in that data stream. If you look in the manual for your software or things that come from your broker, you can see all the different things that you can get in your data stream. You can get a lot more than just, price information and volume. Of course, there's the usual things like bids and asks and all that, but you can also get fundamental information about whatever item is being bought or sold in that particular market. So there's a lot of stuff that you can get in that data stream, but as supply and demand traders, most of that is of no interest to us. Now, that data, again, it's on a busy market, it's a nearly continuous stream of data, and it's coming in at a very high rate. And that's a problem. Okay, the data's coming in far too fast for us as humans to be able to process that and make any kind of a rational decision. So we need something to help us reduce the amount of data that we have to be able to absorb and make a decision on. And we have to reduce the rate at which it reaches us, to a level that we can actually deal with. And as you'll see, that's what we're going to use candles for. Now, to make sure we're all on the same playing field here, we will quickly review candle terminology. Now, you've probably all heard that candles are a representation of price action over a fixed interval. And we're going to go and explore that in some detail here very shortly. But this is the sort of the classic definition of what a candle is. And a candle has multiple parts. Now, this gets back to that simple definition there that candle represents price action over a fixed interval. And basically what we're doing is we're, picking specific points that price has achieved during that interval. So the high is going to be the highest point that price reached during the interval that the candle represents. The low is going to be the lowest point. The open is whatever price happened to be when the interval started. And the close is whatever price happened to be when the interval ended. Those are pretty straightforward and easy. The body of the candle is just the area between the open and the close. And if the close is greater than the open, then the candle is by convention green. If the close is below the open, then by convention, the candle is red. Now, a candle may or may not have wicks. If the high and the low are on the candle body, so for instance, in our example here, if the open was also the low and the close was also the high, this candle wouldn't have any wicks because the high and the low would be part of the body. But a lot of the time, you'll have the high or the low or both outside of the candle body. And then the wick is simply the line that's used to connect the candle body to the high or the low and show us where the high and the low is relative to the candle body. Now, while we're talking about candles, I'm going to throw in two other definitions here. I'm going to talk about a rally candle. So a rally candle is a green candle. So its close is above its open. And it's one where the close is also above the high of the previous candle. Now, of course, we have the flip side of that, which we're calling a drop candle. And this is a candle where the close is below the open, so it's red. And the close is also below the low of the previous candle. So I'm throwing those in here because you're going to see them quite a bit throughout the rest of this presentation. So this way we'll get them out of the way up front. So now that we're all on the same playing field with terminology, let's actually go look at how candles are built. So we said that a candle represents a fixed interval. Well, that fixed interval is a measurement period. Candles are a sampling mechanism. And They have the same advantages and disadvantages as sampling in general. But what we're going to do here is what we do with all sampling mechanisms. We're going to divide up our input signal. And our input signal is going to be price. And we're going to divide it into measurement periods. And the size of the measurement periods all has to be the same. And typically, it's going to be based on something. It's something that we're going to be holding constant from one measurement period to the next. The most obvious thing is time. So we'll start with time. So if we're on a 5-minute chart, our interval is 5 minutes, our measurement period is 5 minutes. And every sample we take is going to represent 5 minutes. Now, the interval doesn't have to be time. It just has to be something that we can reasonably hold constant. So we could actually use other things, such as, let's say 1,000 shares changing hands or 1,000 contracts if you're doing futures. And so every measurement period then is going to have 1,000 shares or 1,000 contracts changing hands. So what we're going to be seeing here is how price changes while those 1,000 shares or those 1,000 contracts are changing hands, are being bought and sold. In the case of time, on our 5-minute chart, we are seeing how price changes over the course of 5 minutes of time passing. So depending on what you're interested in, if you can hold that constant from one measurement period to the next, then you can see how price changes over the course of whatever you're holding constant. So once we've divided our input data stream up into measurement periods, we're going to start by getting rid of all the data we're not interested in, because we only want to look at the price action. So all that stuff about volume and bids and asks and all the other stuff, we're just going to throw that all away. We just want to see what things were really bought and sold for. And now we're going to look at that price action data. And we're going to end up throwing all that away too. But we're going to replace it with a summary. And that summary is going to take some key values from that price action data. So that summary is going to include what price happened to be at the start of the measurement period, what price was at the end of the measurement period, how high price got during the measurement period, and how low it got during the measurement period. So we're getting rid of a lot of data and we're replacing it with this simple summary. And this summary serves to provide data reduction. And it also provides us with a way to visualize the data that was kept. So why are we using candles? Well, we previously discussed the need to reduce the amount of data and reduce the rate at which the data is reaching us. And candles allow us to achieve that. They provide data reduction. We're getting rid of all the data in the measurement period, and we're replacing it with just a simple summary of what happened during that measurement period. We are also reducing the effective rate at which data reaches us. If we're on a 5-minute chart, we get a new candle every 5 minutes. So that gives us the opportunity to look at the candles we already have, to start analyzing those and thinking about those for 5 minutes before a new candle comes in. If we're on a 60-minute chart, we have a whole 60 minutes to think about it before a new candle comes in. So we have dramatically reduced the rate at which new data reaches us. And that gives us more time to think about it and make a reasoned decision as to what to do. And then, of course, the candle gives us a way to visualize this data. And sight is the primary sense for humans. And so whenever you can put data into a visual format, it generally makes it easier for humans to be able to process that data. So this is why we are actually using candles. Now, we said that candles are a sampling mechanism, and they have the benefits of sampling, but they also have the drawbacks of sampling. And the drawbacks of sampling are that things can get hidden inside of candles. When you look at a daily chart, all you're getting is 4 values to represent all of the price action that took place in an entire day. Because all you're getting is the open, the close, the high, and the low. There could have been important things that happened during the day which are invisible because they're inside of those daily candles. So this is why we want to be able to look at multiple intervals so that we can see if anything important is going on inside of those higher time frame candles that can affect what price does in the future. If we don't look at multiple intervals, then there's things that we can miss because all that data is being thrown away. So going to other intervals or even other chart types, like for instance, going from a time-based chart to a share bar chart or a tick chart, can give us a different view of what's going on in the market and allow us to be able to see things that were not clearly visible on the prior intervals that we were looking at. And we'll see some of this in more detail shortly, because we're actually going to start looking at actually creating candles from the raw data. So by changing intervals, we can go and expose different pieces of the underlying data, which can go and give us a better idea of what's really going on. So here is my crude example. As you can probably tell, I am graphics challenged. This was probably the best way I could come up with to demonstrate this. But what we have here is essentially a representation of our base price line activity. We're going to call each one of these dots a transaction, let's say. And we're going to turn this into a series of candles. But before we do that, let's take a moment to actually look at what is here in the raw data before we start turning this into candles. Now we can see a pattern here called a drop, base, rally. And that feeds into another pattern called a rally, base, rally. And that feeds into a rally, base, drop. And then we have a V-shaped reversal here. So the first pattern here is a reversal pattern. And we have a continuation pattern. And then we have 2 reversal patterns. So this is what we're starting with. Now let's see what happens when we start turning this into candles. And we'll start with a low interval. In this case, the interval is 3. So we're going to take 3 of our data points here and we're going to turn them into a candle. And remember, when we're turning things into a candle, what are we keeping? We're keeping the open, the close, the high, and the low. So on most of these candles, we're going to be getting rid of at least one data point. We can see here, for instance, in this candle, we only needed the first data point and the last data point. The first data point was our open and our low. The last one was the high and the close. So we're going to be throwing away all these data points in the middle, and we're just going to be keeping the selected ones we need to make the candles. So we can see how we're getting data reduction here. And overall, this is what we end up with as candles. We can still see the basic characteristics of the original data. So we can still see over here, we have a drop, a base, a rally, and that feeds into a rally, a base, and a rally. And then we have our rally, base, and drop. And then here we have our V-shaped reversal. The picture isn't quite as clear as what we had originally, but we can still see everything we need to see here. So let's go up to a higher interval and see what happens. So here we've gone from an interval of 3 to an interval of 12. So we've gone up by a factor of 4. Most traders tend to space their intervals apart by factors of 3, 4, 5, or 6. So here we used 4. And we can see how things have changed here. So this candle here, here's our open, here's our close, and we can pick one of these to use as the low. So we'll pick the first one here. And we can repeat that process with each of the other candles, picking out the data points we're going to keep as part of our summary of the activity for that interval. And look at all the data that we're discarding here. So an interval of 12 is giving us quite a bit of data reduction. And here with the resulting candles, the picture becomes a lot blurrier than what we had before. It's really hard to see the drop base rally pattern over here. It's really hard to see the rally base pattern, the rally base rally pattern over here. Over here, we have what appears to be a rally, a base, followed by another rally. Yet in the original data, we know that there was a reversal pattern here, followed by a second reversal pattern here. So now the characteristics of the underlying data are being lost in places. And then, of course, we'll go up to our high time frame, let's call it. We went up by a factor of 4. Mainly because we're limited by the number of dots I could draw on the screen. But here in this example, we're throwing away so many data points that the chart really looked horrible when I marked all the data points we're throwing away. So in this case, I marked just the points we're actually keeping. And so your candles are being made just by these few points. And since you're basing your trading decisions on the candles, you're making your trading decisions based on just these few points out of all the original data. And of course, you can also see here how we've pretty much lost all the characteristics of the underlying data. So again, this is just to illustrate the points that candles are a sampling mechanism, and depending upon how frequently you sample, determines whether or not key characteristics can be missed or hidden. And this is why we want to look at multiple intervals so that we can make sure to some degree that we're not missing something critical and that there's not something, critical hidden inside of the candles that we're not being shown. So let's move on now. Or does anybody have any questions about that before we move on? Actually, let's do that first. Is that making sense to everybody? All right. So let's talk about what exactly is supply and what is demand. We all instinctively know what it is, but let's just put some words behind it, make it, a little more formal. So in general, supply is just the quantity of whatever's available for sale. And then demand, of course, can be the quantity that buyers wish to purchase. Now, in the markets we deal with, we don't directly deal with the buyers and the sellers. We have to go through a third party, the broker. And I'll spare you the jokes about how the broker makes us all broker. So we can think of supply here as being the number of unfilled sell orders that the broker has, the number of items for sale. And demand can then be thought of as the number of unfilled buy orders that the broker has. So with this established, let's start looking at the relationship between the law of supply and demand and candles. And we'll do this kind of like a proof in college. And in math, they always used to give us these proofs, go and prove this, that, or the other thing. And so typically when we were doing this, we'd always have to start out, with the facts and the assumptions and the laws and all the other stuff that we were going to use during our proof. So we'll do the same kind of thing here. So we'll start out with the facts. The facts are what the candle provides us with. And the candle gives us 4 facts. It gives us the open, which is what price happened to be at the start of the interval that the candle represents. The close, what price happened to be at the end of that interval. And then the high and the low, the extremes that price achieved during the interval. Now, some folks will say that candles actually give us a 5th fact, and that 5th fact is the interval itself. But we don't need that for what we're doing here, so we're just going to ignore that, and we're just going to go with these 4. So, of course, the law we're going to use is the law of supply and demand. And from that, we know that price only moves when there is an imbalance between supply and demand. And we also know that price is going to move in the direction required to restore the balance between supply and demand. So price is the mechanism that keeps supply and demand in balance. So assumptions. The larger the imbalance between supply and demand, the faster price tends to move. That's a pretty straightforward assumption. We have a lot of people chasing price. Price tends to move much faster than if it's only a few. Now we're going to break traders up into 3 different groups. And the first group is the institutional traders. They're the 800-pound gorillas in the room. They're the large businesses such as banks, insurance companies, etc. They got lots of money. They can have a big impact on the market when they do something. The next group we're going to look at is the professional traders. These are the folks who actually trade for a living and are successful at it. These folks tend to have training and experience. They also tend to be very disciplined, and they rarely give in to their emotions. And this is in contrast to the last group, which is the retail traders, as they're called, the little guys, mom and pop investors and whatnot. They don't tend to have any real training or experience. They're just, flying by the seat of their pants, going with what their gut tells them to do. They typically lack discipline, and they often give in to their emotions. Now, of these three groups, the professional traders and the institutional traders, they're the most disciplined. They do not chase price. They analyze a market. They choose their entry point. They're patient. They don't give in to emotions. They let price come to them. Retail traders, though, again, they're flying by the seat of their pants. They're going on their gut feel, their gut instinct. And so they often give in to their emotions, particularly one we call FOMO, fear of missing out. And as a result, they chase price. Now, as mentioned before, institutional traders, they got lots of money to play with. They tend to place large orders. These orders, they can actually stop price movement in its tracks. If they suddenly go in and order 1 million shares of something, that's a huge order that can take a long time to fill. Price may have to actually make multiple trips to the price point that order was placed at. Now, the institutions, they're looking at monthly charts, weekly charts. Maybe the lowest they'll go is a daily. So they may not even see how many times price has to come back to their entry point in order to get their order filled, because something like that may not show up on a weekly or a monthly chart. But when you drop an order that big, price is going to take a while to get it filled, and it's likely to make multiple stops at that price level. Now, an important thing to note about institutional traders is that the institutions are not monolithic. Every one of them has their own strategy, their own styles, their own analysts, and all the analysts have their own opinions. They all have to have their own opinions so that they can all get hired, right? If they all had the same opinion, we wouldn't need so many analysts. So they all have their own unique perspective of looking at the market. And this means that you can have multiple institutions trading the same market, and their orders are not going to be in the same places. And the final thing to note is that professional traders and institutional traders do sometimes cancel their orders. They respond to changing market conditions. If everybody remembers back in, 2016 when Trump was elected, everybody was expecting Hillary to get elected. And when Trump got elected, that was a big surprise. And there was a huge, huge uproar in the futures markets as a lot of institutions began changing their positions based on their new outlook for the economy. All those changes took place in the futures market and was all over and done with before the regular stock market opened the next morning. So institutions and professional traders can be quite nimble at times, and they will cancel and change their orders in response to changing market conditions. So let's take all these assumptions, laws, and facts, and let's start applying them to candles. And let's see what relationship we can find between the law of supply and demand and a candle. And we'll start out looking at a candle with 2 wicks. So when the candle first opened, we're going to assume that it was in a state of equilibrium. Supply and demand were in balance, price was not moving. Now, if this equilibrium persisted throughout the entire measurement period, what would the candle look like? Well, since price never moved, we would end up with just a thin line, or maybe a dot, depending upon, how your particular software decides to display that situation. But your open, close, high, and low would all be the same, essentially. However, our candle here doesn't show that, our example candle. So what does that mean? It means that at some point after the open, an imbalance between supply and demand developed. And how do we know this? We know this because price moved. The candle shows us price moved. And according to the law of supply and demand, price only moves when there is an imbalance. So because price moved, we know there had to be an imbalance. Now, the other thing is that when price moves, it moves in the direction required to reestablish a balance. So from the direction of price movement, we can figure out what happened. So in this case, price moved down first. And since price moved down, what does that mean? It means we ran out of buyers. So price opened at this price level here. We've got the open marked. And for a period of time, which may have only lasted for a moment, but we had buyers and we had sellers happily trading at that price level. And then we ran out of buyers willing to pay that. But we still had sellers. And some of those sellers were willing to sell for less. So as a result, price began moving down as these sellers looked for buyers. Now, not all of the sellers are going to lower their price, because we know that the pros and we know that the institutions don't chase price. So if there were any professional sellers or institutional orders at that price level, they would still be there. So this means that the sellers who were lowering their prices were who? They were the little guys, the retail traders, or possibly some new sellers who were just coming into the market at that time. So price continued to move down until enough buyers were found to satisfy all the sellers. And when we reached the point where we had enough buyers to satisfy the sellers, we again reached a state of equilibrium. And this occurred at the low. However, that didn't last. How do we know it didn't last? Well, we can see that from the candle. If that had persisted, our close would have been down here at the low. And it's not. Our close is up here. So that means that balance did not last. And price moved up. So if price is moving up, what does that mean? It means we ran out of sellers. It also means that we had buyers who were willing to pay more. And they were willing to chase price. Now, of course, not all of the buyers are going to raise their offers. If we have any institutional orders down here, or if we have any professional traders, their orders are still going to be down there because they do not chase price. So the buyers who raised their offers and are chasing price are, again, the retail traders, or perhaps some new folks who just joined the market. And those buyers are going to drive price up until they finally get enough sellers. And that finally happened when they reached the high. So at the high, we again, maybe for just a moment in time, but we again found balance between the buyers and the sellers, between supply and demand. Now, this upward movement here, you'll notice also, is what created the wick at the bottom of the candle. If price had closed below the open, we would have had a very different candle. But because price closed above the open, we have this big upward movement in price here to make that happen. And that is what produces the wick at the bottom. So now we're up at the high. And again, we have a balance between supply and demand. However, again, looking at the candle, we know that that balance did not persist. So since price came back down in order to reach the close, what happened? Well, we ran out of buyers who were willing to pay more. We also had some sellers who were willing to sell for less, and they were willing to chase price to try to find a buyer. Now, of course, the pros and the institutions, if they really have orders up there at the high, they're not going to change them. So those orders are still there. It's the little guys who are chasing price. And price moved down until we hit the close. What happened at the close? That is when our interval ended. And this downward price movement is what gave us the wick on top of the candle. And since our close was greater than the open, we ended up with a green candle here. So what can we say about all of this? What conclusions can we draw? Well, we can say that a candle with two wicks has an area of supply above its high and an area of demand below its low. We don't know how many orders are in the area of supply at the top or in the area of demand at the bottom, but we know that at the time it was enough to stop price movement because we saw price reach the low in reverse and we saw it reach the high in reverse. So what we can say is that there is some degree of supply starting at the close and going up to the high and beyond. How much, we don't know, but we know there's some there. And we can say that there is demand starting at the close and going down beyond the low. Now, let's talk briefly about, the area here in between the high and the low. And why am I saying that we have some degree of demand starting at the close and going down to the low, and some degree of supply starting at the close and going to the high and above? Well, we'll take the case down here with demand. Price was down here. We had a balance between supply and demand. And then we ran out of sellers. And we had some buyers who were willing to pay more. They wanted to get in on this and they began chasing price. So we start out with a pool of retail customers willing to chase price. And as price begins to move, some of those retail customers are going to leave that pool. And they're going to leave that pool because perhaps they found a seller, in which case they bought, or because the increase in price was too much for them. Perhaps they don't think it's worth it anymore. Perhaps they don't have the money, whatever. But they're going to stop raising their offers. And so as price moves up and this pool of buyers chasing price shrinks, we're going to get orders from people who have not been able to buy, who have left the pool. And these orders are going to be spaced at various places on the way up. So when we actually reach the high and the price reverses and starts coming back down, we now have sellers chasing price. And as they're coming down, they're going to be cleaning out those orders that were left behind when the pool was filled with buyers and you had buyers leaving the pool on the way up. So you'll have orders sprinkled from the close, or you'll have buy orders sprinkled from the close all the way down to the low from the people who started to chase price and then stopped. And then when you get from the close on up, all those orders from the buyers who were chasing price and got off the train, so to speak, all of those have been cleared out by the sellers chasing price coming back down. And similarly, when the sellers are selling and chasing price, you're going to have sellers dropping out of that pool. And their orders are going to be left behind here too. So there's going to be sell orders, in this case, from the close on up through the high. The bulk of the orders we expect to be at the high or above, especially if there's an institutional order. But you can have a lot of, let's call them stranded retail traders with orders in the wick. And then below the close, we would have stranded retail buyers, essentially, and have their orders. And those will be sprinkled all throughout that area. So there's going to be some degree of demand from the close all the way down to the low and beyond. And then again, where's the institutional order going to be? And it's going to be at or below the low. Anybody have any questions about that? All right. So that was a candle with 2 wicks. Let's go look at a candle with just 1 wick. So a candle with 1 wick can identify an area of supply or demand. But without 2 wicks, we can't identify both. So if the wick is on the top of the candle, we can identify an area of supply. If the wick is on the bottom of the candle, we can identify an area of demand. So we're going to look at the case where we have the wick on top of the candle. And you can take that argument and essentially mirror it for the case where the wick is on the bottom of the candle. So as one of my instructors used to say, we'll leave that as an exercise for the student. So we're going to start with a green candle with a wick on top. So what do we know from this candle? Well, we know that the candle opened with the price at the low. We know that because there's no wick on the bottom. We know the price moved upwards because it's a green candle and the close is above the high. The close is above the open. We know that price went from the open to the high. And we had a brief moment of equilibrium. But then an imbalance resulted and price was pushed back down. And we ended our interval with price at the close. And since the close was higher than the open, of course, the candle was green. So what does this tell us? Well, the candle opened at the low and immediately moved upwards. So there was likely a prior existing imbalance between supply and demand. And we would need prior candles to this in order to be able to determine the origin of that imbalance and that move. Now, since price rose from the open, that means we ran out of sellers. It also means that we had buyers who were willing to pay more, and they were willing to chase price. We finally found enough sellers to keep the buyers happy when we reached the high. And that was where we had our brief moment of equilibrium. But at some point before the close of the interval that the candle represents, an imbalance arose, price came back down. That means we ran out of buyers, and it means that there were sellers who were willing to sell for less, and they were willing to chase price. So at the end of the interval, when the candle closed, price is moving down. We were looking for buyers to satisfy the sellers who were chasing price. And we don't know if the sellers ever found those buyers because the interval closed. We would need more candles after this one to see if the sellers ever found the buyers that they were looking for. So what do we know from this? We know that there is some degree of supply starting at the close and extending upwards beyond the high. And again, this would be from the stranded sellers who left the pool of sellers who were chasing price. Now let's go look at the case where we have a red candle with a wick at the top. So we know that the open was somewhere above the low. We know that the open was above the close because the candle's red. Now, since we have the wick at the top and the close at the bottom, price likely moved up immediately after the open. We wound up reaching equilibrium at the high. That's where we found enough sellers to satisfy the buyers who were chasing price and who were driving price upwards. And then price came back and went down all the way to the low and the close. So this tells us that at the open here, we're not really sure if there was a prior imbalance or not. We would have to get the candle before this in order to see. If we had the candle before this and price was moving down, or excuse me, if price was moving up in the candle before this, then we had a prior imbalance, and that continued over into this candle and took price up to the high. But without that prior candle, we don't know. What we do know is that there was an imbalance that formed either before this candle or during this candle, which ended up driving price up to the high. So additional prior candles are needed if we are to determine the actual source of the imbalance, if there was one. Now, we know that since price was rising after the open, That's how we got up to the high. That means we were out of sellers. It also means that we had buyers who were willing to pay more and were willing to chase price, looking for sellers. And we know that they finally found enough sellers when they were up at the high. We had equilibrium there, but it did not last. And at some point before the candle closed, we ran out of buyers. And that resulted in an imbalance between supply and demand because we had sellers who were willing to sell for less, and they were willing to chase price. And that drove price down because these sellers were looking for buyers. And since the candle closed at the low, our interval ended before we could figure out whether or not enough buyers were ever found. And so additional candles would be needed in order to figure out if, enough buyers were ever found to satisfy the sellers who were driving price. So what do we know from this? We know that there is some degree of supply starting at the close and extending upwards beyond the high. Again, if there's institutional orders or professionals, they don't chase price, so their orders are all going to be up at the high or above. But going down through the candle, there's going to be pockets of supply from all of the retail traders who started chasing price and then gave up on the chase. So there is going to be supply starting at the close and going all the way up. Now let's look at candles with no wicks. Well, if the candle's got no wicks, all it can really do is tell us whether supply or demand is in balance. If supply or demand is in balance, what's our candle going to look like? Again, it's just going to be a line or perhaps a dot, depending on your particular trading platform. So essentially, if things are in balance, the open, the high, the low, and the close are all going to be the same. So the candle is going to have zero size. But if the candle actually has a size, it indicates that there is some degree of imbalance. And since there's no wicks, that imbalance must have originated in a prior candle. So we would need prior candles in order to be able to locate the origin of the move and where the actual imbalance in supply and demand originated. And similarly, we don't know if balance was ever restored. So we would need additional candles after our candle with no wicks to see if balance between supply and demand was ever restored. So the one thing we can say is that if you have a candle with no wicks and it has a size, then price is just passing through. Now, we can use the size of the candle to gauge how fast price is moving, because the candle represents an interval. And if the candle is very large, then a large change in price resulted during that interval. And that means that price would be moving faster than if the candle was small, resulting in only a small change over that interval. So we can do that much from a candle that has no wicks. But in general, it just means that price is passing through. Now, let's start looking for areas where supply and demand are out of balance. How are we going to find areas where supply and demand are out of balance? Well, there's basically two methods that we use. We use pivots and swings, or we use what are called base highs and lows. So let's start with pivots and swings first. We're going to have some definitions, of course, so that we know precisely what we're talking about. We'll start with a pivot high. Now, a pivot high is merely a candle whose high is greater than the highs of the candles that surround it. Now, pivot highs and pivot lows are what is known as bar count reversals. And bar count reversals have a strength or a period associated with them. And this is basically the number of candles around our pivot high which have lower highs. So if you have a pivot high of order 2, that means that you have 2 or more candles on either side of it which have lower highs. And if you have a pivot low, we're just going to flip the picture over, so to speak. That means that a pivot low is a candle where the candles on either side of it have higher lows. And if it's an order 2, then that means that it has 2 or more higher lows on either side of it. Now, swings are a little different. Every swing is a pivot, but not every pivot is a swing. So far, with pivot highs, we looked at just the highs of the surrounding candles. Pivot lows, we looked at just the lows of the surrounding candles. When we start looking at swings, we are going to look at both the highs and the lows of surrounding candles. So that's what makes them a little bit different, and it makes them more significant. So if we look at a swing high, starts out like a pivot. The swing high is going to be a candle that has a higher high than the candles that surround it. Now, what separates it from a normal pivot high is that the swing high has to have at least 2 candles on either side of it, which not only have lower highs, but also have lower lows than the swing high candle. And the candles that have the lower lows don't have to be immediately next to the swing high candle either. They just have to appear before we get a candle that has a higher high than the swing high. And we'll have a picture to help illustrate this here in a moment. Now, similarly, a swing low is essentially a pivot low with the added requirements that 2 or more of the candles on either side of it not only have higher lows, but also have higher highs than the swing low. Now, there's a couple of other names for swings that you may have heard or whatnot. I've seen them called superior pivots and stuff like that. But the big thing to remember here is that with the swings, we are taking into account the highs and the lows of the candles that surround the swing. Whereas with pivots, we are taking only the highs or the lows into account, depending upon whether you have a pivot high or a pivot low. So let's actually see this in a picture here. So here we're looking at a pivot high and a swing high. And again, on the left, we can see we have both a pivot high and a swing high. So like I said before, all swings are pivots, but not all pivots are swings. So this is a pivot high because on either side of it, we have candles with lower highs. And in this case, it would be a pivot high of order 2 because we have 2 or potentially more that we can't see. But we have at least 2 candles on either side of it that have lower highs. Now, this is a swing high because we have 2 candles on either side of it that have not only lower highs, but also lower lows than the swing candle. So that's why we have a swing high on the left. Now on the right, we can see we definitely have a pivot. And we have a pivot of order 2. On the left, we have 2 candles that have lower highs. And on the right, we have 3 candles that have lower highs. However, this is not yet a swing, and it may never become a swing. On the left, we can meet the requirements for a swing because we have 2 candles that have lower highs and lower lows than the swing candle. But on the right, we have candles that have lower highs, but we don't have any that have lower lows. So as things stand right now, on the right, this is a pivot, but not a swing. Now, as time goes on and we get more candles, if the candles on the right end up going to the downside, and we get to that have not only lower highs, but lower lows, then this could become a swing. However, we could also get candles on the right here that go to the upside. And if they go and give us a new high, then this will forever be only a pivot, and it will never become a swing. So that's the difference between the pivots and the swings. Now, why are we looking at pivots and swings? These are points where price change direction. And from the law of supply and demand, we know that price only changes direction when there's an imbalance between supply and demand. So that means at pivots and swings, there was an imbalance between supply and demand. And we can prove it right from the law of supply and demand itself. However, the problem we have is we don't know how large an imbalance there was. The only thing we can say for sure is that it was large enough at the time to cause price to change direction. After price changed direction, we don't know how much of that imbalance still remains. So we don't know what effect that's going to have on price in the future when price comes back there. But pivots and swings give us easily identifiable places on a chart where there was a provable imbalance between supply and demand. Now let's talk about base highs and base lows. And we're going to have to define some things here. The first thing we're going to define is a basing candle. So a basing candle is one where the candles that follow it, there has to be at least one that follow it, but the candles that follow it close between its high and low. So given what we've seen earlier in our interpretation of candles, that means that a basing candle has to have an area of supply above it and an area of demand below it. And that area of supply and that area of demand trap price in the range of the basing candle. Now, you could say that price is relatively imbalanced there because it's stuck in that area. But the key is that we have supply above and demand below. They're holding price within the range of the basing candle. And this is what's generally known as basing. The candles that follow the basing candle and form the base, we just call these base candles. And their key characteristic is that they all close between the high and the low of the basing candle. And then a base is the basing candle and the candles that follow it that are base candles. Now, the first candle that breaks the base, it's the first one that closes outside of the range of the basing candle. That is going to be the leg out. Now, we'll see this graphically shortly. But if the leg out closes above the high of the basing candle, what's essentially happened there? Well, the supply that had been previously holding price down and keeping it within the range of the base has now been more or less eliminated, while the demand that was propping price up and keeping it within the range of the base is still there and is left behind. If the leg out closes to the downside below the low of the basing candle, then the demand, which had been propping up price, has been eliminated. And the supply, which had been holding price within the range of the base, is left behind. Now, the leg in, this is typically the candle before the base. And if you're in a downtrend, it's going to be the last candle that closed below a previous candle's low. For an uptrend, we just flip the picture, and it's going to be the candle before the base, which closed above a previous candle's high. Now let's go into some of this stuff in more detail. Oh, I forgot a couple definitions. Now, I talked before about how we have the supply above the base and we have the demand below the base, and how those are trapping price within the range of the base. Well, when price breaks out of the base to the downside, so our leg out closes below the low of the basing candle, we talked about how the demand has been eliminated there, but the supply is left behind. That supply that's left behind is called a base high. And similarly, if we have our base, we have our leg out to the upside. The supply that was trapping price within the base is gone, but the demand that had been propping price up, keeping it within the base, it still remains. And that's called a base low. So base highs and base lows are areas where we have imbalances between supply and demand, and we can prove that they were there in the past. Now let's look at this. We'll look at this graphically here. We can see we have our basing candle, and this is what starts our base. We have supply above it, we have demand below it. And as a result, as these candles try to get out of the base, they're pushed back and they're kept in the base. They close between the high and the low of the basing candle. So we have our first green candle here. It attempted to get out of the base. Supply mercilessly pushed it back, and it closed within the range of the basing candle. And then we actually got some downward price movement. And price tried to break out to the downside, but the demand pushed it back up. And so these four candles are all closing between the high and low of the basing candle, and they all form a base. Now here in this case, we got a fifth candle, and this closed below the low of the basing candle. So that demand, which had been here, propping price up, forcing price to stay within the range of the basing candle, it's gone. But the supply up here that was pushing price down, keeping it within the range of the basing candle, that's still there. That's left behind. And so that's called a base high. And if we just flip this image, we get to see a base low. So here, price turned around, went back up to the upside, broke out of the base to the upside. So that means the supply here that had been holding price down is gone. But the demand that had been propping price up is still here. And so that demand is called a base low. So we found areas where there were imbalances between supply and demand. But we have to figure out how much supply or demand is there. Now, a candle can give us an approximate position for an area of supply and demand, but it doesn't provide us with any information about the quantity of orders at that location. So it can point to an area of supply, but it doesn't tell us anything about how many sell orders are there or what effect those sell orders might have on that particular market and the price action of that market. Well, can we combine candles into patterns to get an idea of what's going on? Well, since one candle provides no information, adding more candles doesn't change that. So multiple candles can help us improve our estimate of where a supply or demand area is really located. I mean, if we had, for instance, a series of candles and they all have wicks on the, let's say on the top, and all those wicks stop at the exact same point. Well, pretty good chance that there's an institutional order there, or at least some large number of, sell orders sitting at that location. So we can get a pretty good idea of where supply is in that case. But again, it's not giving us any indication of how much supply is really there. How many of those unfilled sell orders are really sitting there? So we're going to have to come up with some way that we can try to measure how much supply or demand is at one of these locations that we've identified. But we don't have any direct way to do it. So we're going to have to use something called an indirect measurement method. Now, indirect measurement methods means basically we're trying to measure X by measuring Y. And we have some kind of known relationship between X and Y, such that, for every unit of Y, there's X number of units of X. Or there's, I should say, a certain number of units of X. So we can use that relationship to calculate how much X, how many units of X we have once we measure the number of units of Y. So by measuring one thing, we can calculate how many of another has to be there. And this is often done in the physical sciences, particularly among, the particle physics guys. So we're going to have to come up with an indirect measurement an indirect measurement method. And while we're doing this, what kind of things do we have to keep in mind? What is it that we really need to know? Do we really need to know how many orders are in an area of supply or demand? What use would that be? Let's say we're looking at the SPY and we find out that there's 100,000 sell orders at a given location. Is that really useful? In and of itself, it's an interesting fact, but no, it's not really useful. Because what we really need to know is what effect that's going to have on price movement when price comes back to that location. And so we would have to know a lot of other things also in order to be able to try to estimate what effect 100,000 sell orders at that location would have on price. So, knowing how many orders are there isn't really all that useful. What we really want to know is what effect that area is going to have on price movement. And how precise a measurement do we really need here too? Okay. As traders, we only need a very coarse measurement because, really, what are we interested in? We want to know, is price going to come back to this area and just blow through it? Is it going to come back to this area and maybe stop and go nowhere? Or is it going to come to that area and bounce off in some way? Is it going to break out of that area in one direction or another? That information is far more useful to us than knowing how many unfilled orders are in a given location. So what we're going to try to do here is we're going to try to measure how much supply or demand is at a location based on its effect on price movement. So what do we know about price movement? Well, we know that price only changes direction, or price only moves when there is an imbalance between supply and demand. The larger the imbalance, the faster price is going to move, because the more people we have chasing price, right? We know that institutions can place orders big enough to stop price movement in its tracks. We know that if price enters an area of supply or demand and it stays there, then we've achieved a balance between supply and demand. And if price enters an area and then leaves, well, the length of time spent in that area can give us an idea of how much of the orders in that area have been used. And the speed at which price is moving when it leaves can give us an idea of how much still remains. So if price enters an area of supply and demand and bounces off of it and is moving very quickly, odds are good there's a large imbalance in supply and demand at that location still. So as traders, we are looking to find areas where there is a strong enough imbalance between supply or demand to affect price movement in predictable ways, because that's what gives us our edge. Okay. We want to find zones that we know price is going to bounce off of, because we make our money off of those bounces. So what would we like to see? Well, if price is moving rapidly, that means it's being driven by a significant imbalance between supply and demand. We have a lot of buyers or sellers competing there. We would like to see that come into an area where we believe there's an imbalance between supply and demand, And we like to see that get stopped flat in its tracks, because that means that equilibrium has been established. That means that there was enough supplier demand in that area to completely satisfy the buyers and sellers who were driving price. Then we would like to see it leave that area quickly, because that means that there were still a lot of unfilled orders at that location. And there were a lot of people willing to chase price. So odds are good. There's still a lot of orders in that location for when price comes back there another time. So how do we translate this into candle patterns? Well, we want to have a candle that shows the initial state of price movement. That's going to be our leg in candle. We're going to want to have a base to show that price movement had been halted. And then we're going to want to have a leg out, which is going to give us an indication of how much of an imbalance still remains there. So ideally, our leg in is going to be a single significant candle without any wicks in the ideal case. And that's going to come up into a base. We don't want it to go past the base, ideally, but we want it to come up, have the base immediately follow it. Now, the base is going to have to start with a basing candle. That way we can prove again that there's supply above it and demand below it. And if this is going to be a supply pattern, and it's going to be a supply zone, in the ideal world, all the highs of the candles in the base would be approximately the same, because that would give us a very precise location for where supply is really located. If it's demand, then of course we like to see all the lows of the candles in the base being at approximately the same level, because again, that would give us a nice, precise location for where demand is located. And then the leg out would ideally be, again, a significant candle with no wicks. We don't want it extending past the base. And again, it's a nice big candle. The purpose of that, again, is to show us that there is a significant imbalance remaining there. And that imbalance is big, and that's going to drive price to move quickly. And that's going to give us the big leg out candle. Now, this is going to lead us to only 4 patterns. There's only 4 patterns that are going to meet these requirements. We're going to have the rally base drop, the drop base rally, the drop base drop, and the rally base rally. Everybody who's been trading supply and demand has seen these before. These are the 4 patterns we all know and love. But if we look here at this first one, we have the leg in, which is showing our initial state of price movement. We have our base, which shows that price movement was halted. And then we have our leg out candle showing that there was such an imbalance remaining there. We had a lot of people willing to chase price, and price took off moving at a high rate. And again, you can look at each of these patterns and come to, the same explanation. So we have any questions? Let me check the chat. Let's see, this is assuming some existing correlation. Let's see, that I guess that was about 10 minutes ago. Could you give me some additional context on that? I'm sorry I didn't see that comment until now. Yes, you're exactly right. Yeah, in order to make the indirect measurement method work, you have to have an existing correlation or relationship between the two items, the one you're going to actually measure and the one you want to measure. Yes, so you actually have to have that relationship established. Let's see, could you explain the difference again between a pivot and a swing? All right. Let's go back to that. Okay, here we go. Okay, so the pivot versus the swing. Again, the difference between those comes down to looking at the candles that they're surrounded by. So in this case on the left here, we have a pivot, and it's a pivot high. And it's a pivot high because the candles on either side of it have lower highs. And on the right, the big green candle is a pivot also. Why? Because the candles on either side of it have lower highs. But when we're looking for a swing, we're going to examine more than just the highs of the candles that surround our candidate for a swing high. We're also going to look at the lows. So on the left, we have our pivot high, but this also qualifies as a swing high because the candles to the left and to the right of it not only have lower highs, but you can see they also have lower lows than our swing candle. On the right, we have our pivot high. And on the left of it, we have our two candles that have lower highs and lower lows than our candidate for a swing. But on the right, we only have candles that have lower highs. None of the candles on the right have lower lows than our candidate. So our candidate becomes disqualified, and he cannot be a swing. He can only be a pivot at this point in time. Now, if we say the next two candles that form over here have lower highs and lower lows, then this pivot could become a swing. But until that happens, he's just a pivot. See it now? Okay. Excellent. Any other comments or questions at this point? All right. Then we'll continue on. Get back to where we were. PowerPoint's going to make me go through every one of these. Huh. All right, so this is where we were at. We have our patterns, but now let's start looking at what it takes to make these objective. So what parts of our patterns are not objective? Well, the base as we've defined it is already objective. The definition for the basing candle, which starts the base, is completely objective. The definition for the candles which qualify to be in the base is completely objective. The point at which the base ends is also objective. Okay. So to clarify those, we have a definition for a basing candle, which is completely objective. And that is that the candles which follow the basing candle have to close between the high and the low of the basing candle. That's completely objective. The candles which are part of the base, they all have to follow the basing candle, and they all have to close between the high and the low of the basing candle. Again, completely objective. The point at which the base ends, that's the leg out. That is the first candle that closes outside of the range of the basing candle. Again, that's completely objective. So what's not objective? Well, up to this point in time, we have defined the leg in and the leg out as merely being significant. So we have to define significant in a way that makes it objective. So what constitutes a significant leg in or leg out? Well, the average true range provides a measure for how much price moves from one candle to the next. And so what we're going to do is we're going to use the ATR as our context for evaluating the leg in and the leg out candles. Essentially, we are going to make the ATR our theoretical average candle at that point in time. And we are going to compare our leg in and leg out against this theoretical average candle. And so by doing this, we can make our leg in and leg out candle definitions completely objective. So essentially, we can say that our leg out has to be, let's see, 1.5 times the ATR. And then that makes it absolutely objective as to what constitutes a leg out. Say 1.5 times the ATR or greater. And the thing about doing that is that that's going to be independent of how your software draws the charts. When your software draws the charts, it has to do something called scaling. And you can think of scaling in the way you have a scale on a map, where 1 inch represents X number of miles or kilometers or whatever. Well, you have a similar thing that has to take place when your charting software draws the chart in a window. And this scaling can effectively exaggerate the difference between candles, or it can, reduce the differences between candles. And so when you're trying to eyeball things, you can get fooled by the scaling. Whereas if you're using the ATR as your guide, the scaling doesn't matter. While the candle may be drawn on the chart and look the same size as another candle, you can actually go in and check the high and the low and see what the true size of the candle is, and then compare that against the ATR at that point. So using the ATR can make this completely objective, and it gets around issues with scaling and the way that charting platforms are forced to draw your charts to fit them in the window on the screen. Now, are there other considerations besides these? Sure. For the leg out, we may also want to consider the candle body size. We may want to consider the candle position relative to the base. We may want to consider the candle color. On the leg in, we have those same considerations. And another thing that we can look at is, instead of having the leg in be a candle other than the basing candle, which starts the base, could we use the basing candle to act as a leg in if we don't have a separate acceptable leg in candle? Let's go and examine some of these cases. So what happens if the leg out candle is more wick than body? What's going on here? Why is this a situation that we may be concerned about? Well, we have our leg in candle, we have our base. Our base is showing, again, that price movement was halted. And then our leg out shows that there was a significant imbalance there, and price did indeed break out of the base. And in our example here, which is demand, we saw price surge to the upside. However, price ran into opposition very quickly. And that was able to push price all the way back close to our base. So we may have burned up a lot of the unfilled demand orders that were associated with that base. And if price does come back to here again, it may not be as strong as we would like, and it may not be able to give us the bounce that we're after. So that's why in a case like this, we again prefer the result on the right, labeled more desirable leg out, because that shows that price left the base and was able to overcome any opposition that may have been close to the base. And that's giving us an idea that there, again, is a significant amount of supplier demand, well, in this case would be demand, associated with that zone or that base. What happens in the case where the leg out candle extends beyond the base, as we see here on the left? What happened here? Well, the price signal has some noise in it. Okay, price does bounce around. And if you're on lower time frames, you're more likely to see this than on higher time frames. But on lower time frames, or just in general, if price overshoots the low of the base by a little bit, it's probably not a big deal. If there's an institutional order there, that institutional order was probably a little bit below our low of the base, and the leg out probably just found it. And so if we go and extend our base to include the low of the leg out, then that's probably going to be acceptable, and we can probably get away with it. But if the leg out moves far beyond the low of the base, then that may mean that demand has moved. And we would like demand to be associated with the base. And having the leg out go that far past the base means that demand has moved away from that base. And you're probably better off looking for a lower base and lower zone to work with. What happens if the leg out is the wrong color? Well, in this case here, we can see on the left, we have a red leg out on a demand pattern. That's not something you see very often, but it does happen occasionally. So in order for this to happen, what went on? Well, price gapped out of the base. Now, normally that's a good sign. Okay, that means that there's a very strong imbalance between supply and demand there. However, price ran into opposition, and the opposition was able to push it all the way back to the base. So, if price continues on here and moves away from this, leaving this behind, when price comes back to this, what's going to happen? Well, we had to burn up a substantial amount of demand here. We gapped out, price came all the way back, burning up demand. And then if price continued upwards, burning more demand there. How much demand is going to be left? Don't know. We don't know how much we had to burn in order to undo this, candle moving in the wrong direction. So our initial attempt to break out of this base with the gap out failed. And while the pattern eventually formed and succeeded, because we're waiting for price now to come back to it, we may have used up most of the demand that was there. So that's why this is not a favorable pattern, not a favorable leg out. On the leg in, what happens again if we get a candle with a long wick? So this is another case where price attempted to reverse, but failed. So price came down here, it hit demand. Demand tried to push it back out and reverse. It failed. Price then came back into the base, and then we got the breakout from the base. Again, we had to burn a whole bunch of demand here on this failed breakout attempt. And that again raises questions of how much demand is really left for when price comes back to this formation the next time. And so that's why this is considered a less desirable leg in. And here's a case where we had the leg in, and the low of the leg in is actually below the low of the base that forms after the leg in. So what's happening in this case? Well, where's the institutional order? If there is going to be an institutional order here, it's going to have to be below the low of the leg in. Institutions don't chase price. And institutions can place orders big enough to stop price movement. So what may have happened here is price came down, it hit the institutional order, it stopped, and then you had people start front running the institutional order. And they drove price up, and that established the base here. And then we broke out of the base. So in this case here, if you were to try to play this, play this zone or to play this formation, that would be problematic. Because this could be, what do you want to call it, a soft zone, where if you got a good move down, it could break through the zone, go down here, perhaps to the bottom of the leg in before reversing. Now, if the low of the leg in is only a little bit below the low of your base, you can compensate for this by including the leg in your base, and that would move the bottom of your base. But again, if it's a big gap like over here, you're probably better off going for a lower base, because this really raises questions as to where is demand really located. Okay, good question. For a leg in or leg out, a move beyond the base, if we're going to accept it, how do we do so? How do we define it in a way that's objective? There's a bunch of different ways you could actually use. You could relate it to the ATR. A simple thing to do would be to have a percentage of the leg in candle that you're going to allow to be below the base. But whatever you're going to do, you're going to want to establish that by using back testing. So you can see how tolerant a given market is for this kind of a situation, because it's going to be different for each market. Ideally, you really wouldn't want to ever use, a zone where your leg in extends significantly below the low of your base. You'd really want to avoid that. But again, back testing is what you would want to use. And then you could come up with a way that you could specify that objectively based on the results of the back testing. Okay, so here we have another one of these oddball cases that occasionally crops up. And in this case, the leg in is the wrong color for the pattern being formed. And so again, what's going on here? This is another failed reversal attempt situation. We can see here in the green candle on the left how price came down and it attempted to reverse and go back up, but it failed to do so. And then we had our base form, and then we had our leg out. So what's happening here? Again, we're burning more of the demand that was here, because essentially we're trying to reverse twice. Here's the first reversal attempt, it failed. And then here's the second one, which presumably succeeded, which is why we're looking at, the pattern here. So this is another case where we burned up, a bunch of the demand in our example, and we really don't know how much is left. The only thing we know is that there's less than there would have been otherwise. So this would be a suspicious pattern that you may want to consider avoiding. Now, the question about the base and candle acting as the leg in. The answer is yes. While we would ideally like to have the leg in candle being a separate candle before the base in candle that starts the base. If the leg in candle does not meet the requirements to be the leg in, but the base in candle does, then you can often use the base in candle as both the candle that starts the base and as the leg in. And the reason for this is that, again, candles are a sampling mechanism. And if you shift your starting point in the data stream for taking your samples, you can go and shift sample points from one candle to another. And so you can see that's something we've done here. We've gone and shifted the starting point for our measurement periods that are used to create the candles. And that has resulted in some of the data from what was the basing candle on the left being moved into the leg in candle, giving us an acceptable leg in candle, while still maintaining an acceptable basing candle to start the base. And this is something that's, the back testing has essentially verified. This is something we have back tested, and it does work. But from a theoretical perspective, again, all we're doing is shifting the starting point for our measurement periods. Because again, candles are a sampling mechanism, so we can do this. And by shifting the starting point of our measurement periods, data points shift from one measurement period to another, and we're able to get the pattern that we're actually looking for. So ideally, we would like our leg in to be the candle before the start of the base. But if necessary, we can actually use the candle that starts the base if that meets all the requirements of being a leg in candle as well. So what might a completely objective pattern look like, or pattern definition? Well, we could say something like a base has to start with a basing candle. We want 6 or less candles in the base. All of the candles in the base must, of course, close within the range of the basing candle that started the base. For the leg out, we want the leg out candle to close outside the range of the basing candle that started the base. That's the requirement for being a leg out, right? We can say that we want the leg out candle to be 25% greater than the ATR. So the range of the leg out candle, the difference between its high and low, would have to be 25% greater than the ATR. We can even go farther and say we want the ATR that we're using for this comparison to come from the candle before the leg out. Now, why would we want to do that? Well, there are certain markets, particularly biotech stocks, where you can get huge price movements overnight. We're talking 30 or even 50% price changes overnight. And that can happen because the FDA comes out and announces they're not going to approve a product from these guys, or can announce that they are going to approve. Or you could have something about, something they've been working on for 10 years has failed trials, or, things like that. And since these companies don't tend to have a lot of products because it costs an enormous amount of money to develop a biotech product, that's a big hit to the company when all of a sudden something fails trials or doesn't get approval. So you can see huge changes overnight, and that results in these huge candles, and that can distort the ATR. So by taking the ATR from the candle before the leg out, you can avoid that distortion in the ATR. And you can get better patterns being found. And that's something we found from backtesting. Other things you can do is you can specify things like, the leg out candle must have at least 50% of the candle in the body. You could specify it has to be the correct color for the pattern you're looking for. You could say you want no more than 10% of the leg out candle being beyond the base. Those are all objective things that can be measured or objectively determined. And you can do similar things for the leg in. Let's say our conditions for the leg in are a bit more relaxed. So our leg in only has to be at least 3/4 of the ATR to be acceptable. We still want our leg in candle to have 50% or more of the candle in the body versus the wicks. We want no more of it, no more than 10% of the leg in to be beyond the base. And we want it to be the correct color for the pattern that we're looking for. So this is a simple objective definition for, our patterns. And again, you can get more specific depending on, each pattern you're looking at. But with this, you give a bunch of people the same chart, they should all be able to find the same things. Now, once you've found a pattern, we need to draw a zone or band, your choice. We use those terms interchangeably. But how are you going to do that? You want to do that in a consistent way. And our back testing has shown that the way you draw your zone from the pattern found can have a very big impact on your success rate. So, well, you're going to go and draw a zone or a band from a pattern. What are we going to do? Well, essentially, we're going to draw a couple lines to mark the boundaries of that zone or that band. One of those lines is called the proximal line. And you can think of that as the start of the band. When the band is created, that is the side of the band that is closest to price. And then the distal line is the end of the band, and it is the furthest point from price when the band is created. Now, where are we going to put these proximal and distal lines? Well, there's a bunch of different ways to do it. And we could spend a lot of time talking about it, but what it comes down to is we're going to group them together into 3 groups based on the width of the resulting band. We'll look at an example of a way to draw narrow bands, wide bands, and then something in between. But the thing you want to think about here is the trade-offs that are being made. If you're drawing your zones narrow, you're reducing your risk. Most people, when they trade a band, they'll have their stop placed past the distal line by some amount, and they'll usually be getting in somewhere near the proximal line. So the width of the band then is directly related to the amount of risk involved, because that's the amount that you're risking. Having narrow bands reduces that risk. However, it also reduces the chances of getting into a trade. There will be a lot more times when price will come towards your band and then reverse before reaching it. And so you miss your opportunity to enter. So you have to go and balance the reduction in risk against the reduced chances of getting into a trade. Now, wide bands, well, that obviously increases your risk, but it also increases your chances of getting into a trade. On a lot of markets, drawing the bands wider back tests better than drawing the bands more narrowly. Why is that? Well, in a trending market, price never goes in a straight line. So you're going to have pullbacks. And when the zones are drawn wider, you get more opportunities to join the move on the pullbacks, because the pullbacks will come and, go into your zone, usually by just a little bit, but it still gives you the chance to then get in and join the existing move. With the narrower bands, you have fewer opportunities to get in on those pullbacks. Medium width bands, you're basically making an attempt to balance risk along with, the chances of getting into the trade. And how well that's going to work really depends upon the market that you're trading. And back testing can really, again, show you how well your trade-off there is going to work. Now, while there's, again, a lot of different ways you can draw your bands, we'll show you just three. Okay, one for narrow, one for wide, one for medium. And there's a bunch of different variations that you can use on these and come up with others yet. So for drawing narrow zones or bands, on the left here, we have an example for supply and on the right for demand. We'll start with the supply side. We're going to place the distal at the high of the base. And the proximal line we are going to place at the bottom of the highest candle body in the base. Now, this tends to give you fairly narrow zones. And again, that's, a trade-off. The narrow zones reduces your risk, but a lot of times you'll see price will come back and will turn before reaching the narrow zone. Now over here on the demand side, we're just going to flip this. And the distal line is going to be placed at the low of the base. And the proximal line will end up being on the top of the lowest candle body in the base. Now, one trade-off that we can make this will give us a medium width zone fairly consistently, is instead of using the lowest candle body in the base, we'll go with the highest candle body in the base. At least for demand, and of course you flip that for supply. So we'll go with the supply here on the left. We're going to start out just like we did before. We're going to place the distal line at the high of the base. Now this time, we're going to put the proximal line at the bottom of the lowest candle body in the base. Before, we were using the highest candle body in the base. So this is going to give us a wider zone. And wider zone means bigger risk, but more chance to actually get into the trade, particularly on pullbacks. If we look at the demand side, again, we're going to place the distal at the bottom, at the low of the base, and we're going to place the proximal line at the top of the highest candle body in the base. And finally, for drawing wide zones, an example of that is we're just going to use the high and the low of the base for our proximal and distal line. And this is going to tend to give you a wide zone, which is going to increase risk, but it's also going to give you more opportunities to get into the trade, particularly on pullbacks, because you have a lot fewer pullbacks that will come close to the zone and reverse without touching the zone or entering the zone. And again, for a lot of markets, this back tests better than other methods. Now, some final notes on zones or bands. You often hear the term fresh being used in conjunction with zones or bands. And all that means is that price has not returned to the zone since it was created. That's all. And a zone or band is considered broken once price returns to it and goes beyond its distal line. And broken zones or bands generally should not be used again. because the imbalance that they represented between supply and demand is no longer there. Now, while the patterns and, the candle characteristics and all that stuff that we've discussed here, while those will allow us to locate significant imbalances between supply and demand, those imbalances existed at the time and the price level where they were found. There's no guarantee that the imbalance still exists when price returns there. Remember, traders do cancel their orders. They do move their orders in response to changing market conditions. And so the amount of a supplier demand imbalance at a given location could actually rise, or it could decrease as market conditions change and orders are moved by by traders. So you always have to keep that in mind. The other thing is that prior imbalances between supply and demand, that's just one of the factors that you need to take into account before placing orders. When you're coming up with your trade, when you're designing your trade, you have to take a host of things into account, not just prior imbalances. So what other factors might you want to take into account? Well, you want to look at price momentum. Okay. If you have a lot of price momentum, that could overwhelm a zone and cause a zone to fail. There's another phenomenon called reversion to the mean. And that happens when price gets too far away from its average value at that point in time. And that can cause price to want to move back towards the mean. And again, that can be quite a strong force and can overwhelm a zone. You have changes in market volatility. You have market influencing events like we talked about earlier with the election of Trump back in 2016. That changed all sorts of things and caused a huge move in the futures market. So there's all sorts of things that could go and become more important at a certain point in time than a prior imbalance between supply and demand. So you need to go and keep all these things, in mind when you're planning a trade and deciding whether or not to, select a zone. So always take into account as many factors as possible when planning a trade. And so this ends the presentation for today for part 1. Part 2 will be next week, where we will be exploring the intricacies of trend and looking at curve. And if anybody has any questions, feel free to ask now, or you can come back later to the Foundry, or you can send an email. If you want a PDF copy of today's slides, please send an email. Put Making It Objective Part 1 slide deck as the subject line so we can quickly pull those out and respond to those. But hopefully this has been useful to you all. Thank you for coming. Everybody, keep it green. Does anybody have any comments or questions? Does anybody know how to shut this all down? No. Thank you, Jeff. Thanks for coming. I hope the session was useful to you.
One of the host machines will need to shut it down, Ben.
All right.
Probably stop sharing.
I don't know how to stop the live streaming, so.
Let's see if I can log in as host.
I have no idea how to stop it.
Are you having trouble with the stream, live
Yeah.
stream, Ben?
Yeah, don't know how to stop it.
Isn't there a drop-down menu right to the right of it up at the top where it says live stream?
The only thing it says is view stream on YouTube or copy streaming link.
What about down at the bottom,
I don't see anything on the bottom about it.
where you turned it on?
I didn't turn it on.
Who was running it?
Lisa turned it on.
Oh, is it running through the Foundry?
I believe so.
Oh, you have to go to that virtual machine then.
See, I don't,
Here, I'll log into it if that's where it's at.
She may have logged in some other way because I don't see it here on either of those.
Oh,
The only thing I can do is cycle the room, and I'd rather not recycle the whole foundry. So I don't know how she did it.
it's running on her machine.
Oh. So then what do we do?
Let me try and log in to the Zoom account and see if we can kill it there. I don't know if we can. You may have to cycle the room. Yeah, looks like it. That's the only way to kill it. There's nothing in that I can find inside of the account to do it.
Okay, well, I guess we'll have to cycle the room. Sorry, everybody. So let me cycle the room here.
All right.
Okay, the room will be back up. Hmm. Oh, she stole host too. So that's not letting me. Isn't this funny?